Good morning and Happy New Year. Welcome to the first Market Monday of 2023. We are glad to say sayonara to 2022, a year of extremes, and turn our attention to the possibilities of 2023. As much as we'd like to call the all clear, as investors, we have to see the world not as we want to see it, but as it is. As Chad mentioned several times last week, long-term investing inherently deals with an unknown and unknowable future. That's what we grapple with when constructing portfolios. Like stocks and bonds, both down double digits for the year. Not only is it rare for both stocks and bonds to be down for the year, happening only 4 times before 2022, going back to 1928, but none of those times saw both fall double digits in the same year. The worst year before last year was 1969, when stocks fell more than 8%, while 10-year treasuries were down 5%. Compared to last year, that's a big yawn. So while nobody's doing cartwheels to celebrate last year, we sincerely commend you for surviving and sustaining what was the worst 1 or 2 calendar years for a balanced portfolio, certainly in modern history, maybe of all time. Another surprising event last year was the Fed openly pushing for the stock market to fall. Remember, there are 12 Federal Reserve branches, each with its own president. The Minneapolis branch's president, Neel Kashkari, stated he was happy to see the stock market sell off after the Fed's late August Jackson Hole summit. Volatility and drawdowns are part of the game when investing, but to see Fed officials openly state their pleasure at the stock market falling is something we really haven't seen before. Maybe it's a function of the immediate and open nature of social media, or maybe it's the attention economy, where attention is often more valuable than what you actually say. Maybe it's a high-level public relations signaling campaign trying to talk markets down to bolster the Fed's credibility. Probably some combination. And though we did get a taste of Fed Chair Powell's style in 2018, when he was 3 years into a low and slow hiking campaign, that one right there, continuing to hike into a slowing economy. But then pausing, see right here, the market basically bottomed right here on December 24th, 2018, down almost 20%. Then the Fed was done. Then 8 months later, started lowering the rate again. But this time, despite much more severe slowing economic data, even plenty of recessionary indicators like LEIs, an inverted yield curve, and a bond market drawdown, the worst in the history of the aggregate bond index, and tech stocks, crypto, even market darlings like Amazon, Microsoft, Facebook Meta, Google Alphabet, even Apple, selling off 25, 40, 50, 70, almost 80%. The Fed is still hiking with a staunchly hawkish tone, despite clearly thawing inflation we talk about almost weekly here. A major departure from prior Fed behavior, which has also caused mortgage rates to double, more than double, going from under 3% to over 7% in October and November, though that appears to have come down a tad in the last month. While rates jumped at the fastest pace in decades, current levels, at least historically, aren't extreme. While this is causing short-term disruptions in housing, which could have ripple effects throughout the entire economy next year, we reiterate last week's theme of market imbalances seeking equilibrium. If anybody was trying to buy a house last year, or if you know somebody who was, it was clearly an overheated market. We don't believe housing will experience a 2008-like obliteration, but a cooling and a settling into some semblance of balance. All right. Even though 2022 calendar year has come to a close, of course, we'll still revisit it often as the main issues are still front and center. But for now, let's turn our attention to what's ahead from a planning standpoint. You may have heard on December 23rd, the U.S. House passed a federal spending bill authorizing roughly $1.7 trillion in new federal spending. Among the 4,000-page document was the much-anticipated retirement bill known as Secure Act 2.0. Secure 2.0 arrives nearly 3 years to the day after its predecessor, the original Secure Act, was passed in late 2019. You may recall original Secure Act pushed back the required minimum distribution, or RMD, age from 70.5 to 72. It also eliminated the stretch IRA option for non-spouse beneficiaries of retirement plans. Meaning before, a non-spouse beneficiary could stretch withdrawals of an inherited retirement account over their lifetime. But after original Secure Act, that window was and still is limited to 10 years. Let's get into Secure 2.0. We'll be touching on these topics more detailed throughout the coming year. Most reforms will not apply to most of you, but some will. Good news is, you don't have to remember any of this. That's what we're here for, to understand your unique situation and apply the changing laws to your unique situation in the most advantageous way possible. Custom fit, tailor-made, bespoke. So sit back, relax, and enjoy this quick tour of Secure 2.0. RMDs are pushed back again. RMDs were first established in 1986 with the beginning age of 70.5, an age which didn't change for more than 30 years until original Secure pushed it back to 72, starting in 2020. Here's how it works. If you're currently taking RMDs, sorry, no changes here. If you happen to turn 72 this year in 2023, you can wait an extra year till age 73 in 2024. This age 73 start date stays all the way till 2032. Then beginning in 2033, RMDs are pushed back to age 75. It's a little easier to go by birth year. So born in 1950 or earlier, RMD age is 72, no changes, or 70.5 if you reach that age prior to 2020. Born 51 to 59, RMD age is 73, and born 1960 or later, RMD age is 75. But remember, required minimum. It's possible your unique retirement cash flow design includes IRA withdrawals even if you haven't reached this age yet, or maybe withdrawals in excess of your required minimum amount. Perfectly fine. Couple changes to Roth accounts for anybody who has a Roth 401k, not Roth IRA, but a workplace retirement plan Roth account. Starting in 2024, no RMDs from there. Also in 2023, we'll see 2 new types of small business Roth retirement plans, the SEP and the Simple. Also for employer match, before, the employer match could only be deposited into a pre-tax account. Now employees can elect to have their employer match deposits into a Roth account. Just keep in mind that match will be included in the employee's income. Here's one for high income earners, defined as $145,000 or higher. If you're making your age 50 plus catch-up contribution, that will have to be made as a Roth contribution. So that's $22,500 max contribution for everyone. Another $7,500 as age 50 catch-up contribution, which will have to go to Roth for high income earners. If your plan doesn't allow Roths, then get this, catch-up contributions are effectively off the table for you. So please expect us to be making sure your plan has a Roth option. There are a few nuances and opportunities with how your income is counted, so of course your advisor will be customizing this with you. As you can see here, Secure 2.0 is phased in over time. This year we get to push back RMDs and a couple of Roth options. A lot happening in 2024. A couple more things in 2025. For example, starting in 2025, there's a special catch-up contribution increase for those age 60 to 63, but that's still 2 years away. Plenty of time to digest all this, but again, that's why we're here to absorb everything and apply it to your unique situation in the most advantageous way. Thank you for your continued partnership throughout the years, especially a tough year like 2022. We look forward to better and brighter days ahead in 2023. Have a great week.